Hey guys, Mike here. So we get to answer all your questions and stuff like that. So I'll definitely need your help on this one. But this is one of the funnest ones I've done because you ask really technical questions, and so we get to talk about liquidity. I'll get to show you how that works and everything with market structure, change of characters, gap fills, like all kinds of good stuff, which I'll show you and everything, and show you some pretty cool like trade view indicators you can use and stuff like that, and then a whole bunch of different topics you guys came up with. So I'll do my best, and feel free to jump in and help the community out, okay? So getting into the first one here from Jeffrey. He says, don't overthink this. A lot of liquidity has left the market and will remain gone as long as the treasury yields are attractive. Any rally will have short legs, and that actually could be true because obviously he's talking about this isn't TINA anymore, where there is no other alternative like it was in 2010 to 2020. But now you have the bond market and yields keep going higher, so now people can get 5.25, something like that. And so even in like a money market account, you get in between like 4 and 5. So there is another alternative now. And so especially big money will flow to that as well, especially the riskier our debt gets and stuff. So just kind of keep that in mind. So we'll have to see, right? He keeps saying all his money on the sidelines is going to come flowing in again. But one thing it does drive the stock market too is leverage, right? And so right now, as I showed you, margin debt the other day is still way down. So as soon as that starts spiking and people start taking out leverage, you can still drive a stock market up. So again, what to see plus short coverings, things like that. So we'll see how it plays out for November and December. Now, question from Jim here. He says, what exactly do you mean by grabbing liquidity? Great question, Jim. And I'm actually going to go to a members video I did that says how the market moves, right? And so these shaded areas, again, you can look all this up because this is like a 20-minute course, but this is an indicator. It's FVG, fair value gaps. Those right there are imbalances between the sell side and the order side, right? It's these big candles. There's a 3-candle series, and the bodies, if you look at a chart, they're usually covered up by one candle to the left, one candle to the right. They cover that middle candle completely up. When that doesn't happen, it creates an imbalance. Now, you can see, I mean, I believe, and most people would believe, hopefully, that the stock market is run by algorithms, right? And so all they're doing when trying to grab liquidity means they're trying to fill orders, right? And so if you watch just these imbalances, right? So you'll have a change of character, which means maybe the market's moving down in a bear structure. But when you're looking at it, just look at the fair value gaps and how when they show up, that's when they're there, right? And the market will just continuously hunt them, right? These algos has to fill these orders. We're talking about billions and billions of dollars worth of orders. And you can see, I mean, this is coming from October forward, right? This is 10x as we're moving through here. And as you can see, it just keeps moving up. And then remember, it's expanding and then it's contracting. It's expanding and it's contracting. It goes in both ways doing this. And it just keeps filling those fair value gaps. They're like magnets because it's trying to fill these orders, right? And when they can't fill orders, when you start to get up there, and plus what's really cool about this, looking at this right here, is you'll see these trend lines, which, I mean, you always show them to you every day, but you'll see how powerful these trend lines are when it comes to support, resistance, things like that, and just how they react off that, right? Now, if you look, most of these trend lines are moving averages or like prior days lows and highs, prior week lows and highs. They actually, a lot of times, line up with something very important, whether it's an order block, whether it is a fair value gap, something like that. So again, this is a simplified version. I said you can make a 50-minute video on this, but I just want you to be able to see it with this indicator. And if you're in TradeView, again, if you need an account, just click the link in the bottom. Just type in FBG. There's many different selections you can use, and these will pop up as they form and everything. And so it's just a cool thing to watch. And again, the replay button up there to the top, if you ever want to do this, you can see exactly how the day went and how the market moves. So hopefully that helps you when we're talking about liquidity. It's probably more than you wanted to know, but that's what I'm talking about. You can see what happens. See what happens when that trend line was broken right there? That's a major trend line. All of a sudden you saw a huge move down, right? So anyway, I hope that helps out, Jim. Let me know. Now, can you please explain on gaps in the charts? I hear a lot of gaps need to be filled, but that is not happening in all cases. So why and when are gaps filled? I mean, the one thing to think about is the different types of gaps, right? So you have like Tesla, you have a big earnings gap. This is when you get your largest gaps. It's going to be during earnings. NVIDIA probably has the largest of all time, right? When they gapped up. I know I have any proof on this where it says like usually gap downs will fill faster than gap ups. Because for order from gap ups to fill, it has to come back down, right? Which usually will happen in a crash. But if you look at Tesla's chart, there's plenty of gap ups that did back, like I think it was 2016, 2018, or 19, where they never filled because we didn't crash long enough to go back there. But usually when the market starts to expand back up from contracting, that's when you'll get the gap downs filled. Now there's an indicator called gaps, right? You put it in there, you turn it on, and again, this is the replay mode, right? And gaps can act as resistance. they can act as, more importantly, magnets, right, where they just suck them in and bring it to it, and it'll fill it. And once it fills it, it moves very quickly through a gap. So if you're sitting near a gap, you're going to have, especially if you're playing options, a lot of people will see that, you'll have a big move through that gap, so there's just not a lot of resistance, right, because it's a gap, right? And so again, a lot of times what happens, I've showed members this multiple times, when it's coming into a gap, take your fib, draw from the top to the bottom. Usually once it hits that 50 fib, it's going to bounce. Tesla did that yesterday, I think 2 or 3 times in its gap for completely filling it. And so again, that's the gap indicator. That's what happens with gaps right there. So hopefully that helps you out and everything. So like the IWM has a boatload of gaps above it. And so when it starts, if there is any bullishness that starts coming in IWM, those gaps are going to be magnets. When it hits it, it's going to be resistance for it at first, or it's going to fly through it like a hot knife through butter. So just keep that in mind. Hope that helps. And guys, before we continue, if you get anything out of this, please hit that thumbs up down there. I really appreciate it. And if you like the material here and the videos, think about subscribing. Next comes from Tamir, and he says, I was wondering if you could tell us which website you are using to track options flow. I don't have any relation to any of these, but I know Cheddar Flow is a popular one. They also have a Twitter account you can go on and get them. I know Option Strat. I think Unusual Wells has one as well. Please put in the comments what you guys think. The best one to do is, I actually need to subscribe to one, to be totally honest with you. I keep putting it on my list to do. I just don't do it because I have a lot of other subscriptions and stuff. But, you know, it seems sometimes to help out for sure, especially when it comes to Tesla and certain stocks. Now, the next one comes from Daryl, and he says, until the VIX hits 26, I'm not a buyer. And I know exactly what he's talking about. This is the chart right here, and this is the trend line. I was hoping it was going to go to 26 for sure. We didn't get that. The reason why, obviously, if it hit that trend line, it mostly reject down. When the VIX drops, for those who don't know, that's usually when you get a nice big move up. And so if it can go to 26, which would be great if it does it next week, it's actually be a gift. There's another thing just to look at when you're looking at the reversal and stuff. And so just keep that in mind, guys. The next one comes from Bernard. He says, hey, Mike, very good work, man. When do you think TMF is going to take off? I'm going to go ahead and answer that right now here. Not sure yet. And I'm laughing when I say that because I've done so many videos on TLT, and TMF is a 3x leverage ETF to TLT. And you can see it's in the complete dumps. This thing is a train wreck. It has been ran over by the train. The train is back over it 3 or 4 times. It's a hot mess. Look how oversold this thing is. Not just on the daily. Look at the weekly and then go to the monthly. That is rare, man, that you see any chart oversold in the monthly. And it was twice. Look, up there it was oversold. What happened? It went down even further, right? So just because you see something oversold, don't mean it can't go down farther. I know I've said that multiple times, right? And you would think there would be a bottom, but the problem is, in this bond market, if you watched my video yesterday, if not, I'll link it at the end, I explain what the heck is going on in the bond market. It's like something we've never seen before because we never have, okay? And so, you know, people keep trying to bottom fish it, and hopefully they're right. But when it comes to TLT, because this will affect TMF as well, understand, as I told members, that square part right there, that is where you're hoping to get back to. That is normalcy, okay? That whole thing above it, that big circle, you ain't never going to see that. If you see that, we're going into a Great Depression because we shut down the world again, all right? That only happened because we issued trillions of dollars in debt to support the whole country and all the companies and everything else, right? We were buying corporate debt. We were buying everything that moved. Okay, so that should never, ever, ever happen again. If you look to the left, from 2011 to 2019, that range in that box, that was normalcy. That's what you're hoping to get back to, which is a big move up, by the way. When it's going to happen, your guess is as good as mine. Now, Blake says, I appreciate your take on things and have a question. What is your take on shorting the market? And if so, when does one go from day swing trade to a trend trade? And how do you adjust your position to take on the risk for this move? I'm definitely not the person who's a great shorter. I buy puts. I don't even actually short the stocks, which I need to start doing, to be honest with you. But I'll say this. The biggest thing you see out there, what people are doing, they'll try to short right here. When you're setting at the 50 Fibonacci level, the 200 moving average, all this stuff is setting their major support. Like, you don't want to be trying to short here. You can do it. This ain't financial advice. Do what you want to do. But obviously, when you're coming up to major resistance like this, or a trend line where you've repeatedly bounced and got rejected off of, and you know you got your feel for what's going on in the market right now, that's where you want to be shorting. That's where you want to be longing and covering your shorts right there, just in case, right? And so when it's at the bottom. And so another one to do is, I always say nothing good happens below the 200, right? If you're looking for long-term stuff and you don't want to ride your portfolio down to zero again, you know, just pull up the daily 200, go to the weekly chart. And again, almost every time what you'll see is it'll break the 200, retest, and then reject and go all the way down, right? You see it right there in 2022. You see it right there in 2018. You go over here to 2008, same exact thing happened right there. And if you go to 2001, you'll see the exact same thing. So that's all I'll say about shorting. Please, in the comments, feel free to answer this question in more detail. Now, the next one is BJ Creek says, when are you going to accept the inevitable? Stocks and real estate are in a massive bubble. And the sooner we realize this, the sooner we can all get back to investing on valuation. I can't speak for real estate because there is a shortage in real estate, and that's what's causing prices to go up, things of that nature. But if you look at the Warren Buffett indicator, yeah, we're right 1.2 standard deviations up right now. If you believe in that indicator, again, when it gets to 2, that's when normally we have huge crashes. But in 08, it was barely above zero line, right? So, yeah, a lot of stocks aren't overvalued right now. A lot of stocks are in the dump, actually. It's just, again, if we didn't have the Magnificent 7, we would be so far down this market, it would be insane. Now, again, for those in real estate, feel free to answer in the comments, because I know you know a lot more about that than I do. James talks about, when we're talking about bankruptcies and things like that and transportation, he let us know that check out Convoy on the logistics space, closing their doors, backed by Bezos and Gates. And what he says is truckload transport, one of the backbones of the U.S. economy, I'd say, as it moves and is a reflection of the goods we consume, has been flashing panic for a good bit now. As I think I told you about somebody else last week said the same thing. Things look bleak, but that doesn't mean the market won't go higher in the next few months. That's exactly right. And I did look this up. This just happened Thursday. Digital freight network Convoy Incorporated was forced to shut its doors after no viable options to continue operations emerged. They're number 54 in transports. I guess they're a pretty dang big company. And I showed you the chart the other day because I said, we lost this major trend line. We lost the 200 moving average. It's at a major support right now. So we either get a bounce from here or these stocks are going to go a lot lower. And again, the reason why this is important, if you, I'm going to go ahead and pull up a monthly chart here and let you see. Let me go to the monthly, and you can see before every recession what happens. The transports tank, right? That's kind of a leading indicator for you to say, uh-oh, not good, because that is the backbone of the country. Now, the next one is the opposite, right? And we've been talking about this like all the time. I travel every single week to various locations all over the Pacific Northwest, and we are constantly booked, and everything is packed at all vacation spots. Then you got, Jeff says, that's what I'm seeing here in the Midwest, and I can tell you right now, that is what you're seeing in the South. Because like I said, we just went to the mountains, and all these cabins, every one of them were rented out. Okay, and these weren't cheap cabins. We went with multiple families. And so every one of them in North Georgia, so that would be the South, was the same way. And so, again, I think the reason why you're seeing that, people go, where are they getting the money from? They're not making big purchases. Seriously, if you ain't got to buy a house because it's too expensive and the rate's too high, you ain't got to buy couches and, a range or a refrigerator or lawn equipment to furnish, for your new house or wherever you just moved to, you have money. And so I think that's what's happening, right? And I'm sure some people are also taking out lines of credit on their house and using the equity and all that good stuff to do stuff. So, I think that's why you're seeing that. I really do believe that. So we start to see that tick down. Keep an eye on that. Now, the last two go hand in hand. I think this is when I was talking about the government and, how there's two different kind of economies and stuff. And with the debt, it's gotten out of control at this point in time because how fast they're piling it up. And so John says, 40 years of trickle down, you can think for the minimum income to buy a home being 3 times what the average person earns. And then he goes on to say, as far as corporations raising guidance, they certainly can. It's called pricing power. There is no competition, so they just keep raising. Corporations do not care about the workers nor the consumers. They only care about the stockholders. That's true. I'll elaborate that on in just a minute. And then you got next viewer says, does the U.S. government have ways they can figure out this debt problem? Obviously, this administration is focused on the debt problem, but is there higher ups or people that can figure out paying off this debt, or is there no hope for this debt and it's going to continue to spiral out of control? Wonder how government is going to work with Treasury to get interest rates down since it's amplifying the debt. And I want to go back real quick to John's comment and say, yes, trickle-down economics is a freaking disaster. That was the thing, I think Reagan came up with that, where it's like, people at the top, we make them rich, they'll turn around and create jobs, and everybody will prosper. That's ridiculous. That's why you see this income inequality. That's why 7 people are worth as much as half the country now, okay? Big mess up there. But they keep trying to say it works. It really does not. The other one was, when I was saying raising guidance, I'm not talking about the companies. I'm talking about analysts. They keep raising 2024 like guidance for revenues and EPS and stuff like that. Not the companies. The companies do whatever they want to do for sure. And you're right, there is no competition because there's no such thing as monopolies in America anymore. So that's why that's going on. Now, as far as our other viewer here talking about the debt and everything, can they work it out? No. If you watched my video yesterday, you already know my answer to this question. Again, watch it. I know I did a rant on it. No, it is a total crap show up there. Remember, most of these people up there are unqualified. A lot of them are lawyers because they're passing bills. Have no clue. I mean, first of all, they wouldn't even know. I guess in the way if somebody set me down and showed me the books too, I'd be like, huh, interesting, you know. But understand that there is no way to ever balance the budget or to rein in the debt because the way the country is propped up, it's propped up on the stock market, right, and the bond market stuff. That's what it's propped up on. When it's propped up on that, you can't. Like they can. I've said this before. I'll say it till I'm dead. Basically, that there is no way to balance this budget because you'd have to cut $2 trillion out, or cut $1 trillion, raise $1 trillion in taxes. They're never going to raise taxes enough on the really wealthy people and the millionaires because they're all millionaires now. Right? They're not going to do that because they did it on them. They're doing it on themselves. They'll tell you to do it. And there's some way to circumvent it in the end, right? And so even Paul Tudor Jones said it the other day. He's super wealthy, and he says there's plenty of room to raise money on the wealthy, right? But they are not going to do that, right? Why? Because the wealthy is who's writing their checks to make sure that don't happen. Okay, so no, we'll never do that. Plus, do you realize how much wasted spending goes into the economy? How many times we paid for a jet and never came out, never worked, right? But we spend $900 billion on defense for a reason. And it's not to make us safer. I can promise you that right there. Anybody who's been in the military will tell you that mess. All right? But no, because everything that goes to the troops, over half of it goes to contractors, not to the military, not to the military soldiers who are actually on the front line and stuff. Please get the heck out of here. We'd love some better MREs when I was in. That'd been great, or better equipment, but no, you know. And so you forget about that. Pay raises would be good too, by the way. It goes to contractors. That's why they're like the richest zip codes all around DC. That's where your defense contractors are, defense companies and stuff. So yeah, that's never going to happen. So no, not going to happen. And Social Security and Medicare obviously are going to be even more expanded because by 2030, the baby boomers will be retiring and stuff. And so they're going to get their checks. So that'll cost money. But what they're going to do is start cutting Social Security and Medicare for people who aren't there yet, obviously. So they'll probably do that before they start cutting defense or anything else. So yeah, that's where we're at. Good luck with it. That's all I can say. I wish I had better news on that one. Let me know in the comments what you think. So anyway, guys, I appreciate all the questions, all the comments. I actually really enjoy doing this video now for sure. So keep them coming, and I'll see you tomorrow.